Ever wonder how insurance companies make sure they have enough money to pay for all the claims that might come their way? That's where surplus and capital reserves come into play. Let's start with the basics. A surplus is essentially the cushion of money that remains after an insurer subtracts its liabilities, like expected claims and operational expenses, from its total assets. It's a measure of financial strength and stability. Capital reserves, on the other hand, are funds set aside to ensure the company can pay future claims. These aren't just rainy day funds. They're required by regulators to protect policyholders and keep the insurance market functioning smoothly. Now, for most people this might sound a little abstract. So think of it this way: if an insurer collects $1 billion in premiums in a year, they don't get to keep it all. A big chunk goes toward paying current claims, funding future ones, and covering operational costs. What's left, if anything, is profit, which can be added to the surplus. That surplus is then used to meet unexpected events like a record hurricane season or a massive legal judgment. Managing surplus and capital isn't a one-size-fits-all job. Different companies hold different levels depending on the types of risks they write. Insurers focused on catastrophe-prone areas need to hold more capital in reserve, while those writing standard auto or home policies might not need as much. But too much surplus can signal inefficiency or missed investment opportunities, while too little raises red flags with regulators and rating agencies. There are plenty of challenges in managing this balance. Catastrophic events like hurricanes, wildfires, or large-scale lawsuits can drain reserves quickly, leading to year-to-year volatility. Inflation, social inflation, and rising claim severity have made it harder to predict how much money insurers will need in reserve. On top of that, investment returns on reserves, often a secondary source of profit, can fluctuate due to economic conditions like interest rate changes or market downturns. Still, there are also opportunities. Companies with strong surplus positions can take on more risk, expand into new markets, or ride out tough times without raising prices as sharply. They can also use that capital to invest in technology, improve claims efficiency, or offer more competitive coverage. Capital reserves also play a key role in how insurers adapt to changing markets. If catastrophe risk is rising, insurers may raise capital, shift their underwriting strategy, or transfer risk through reinsurance. In times of economic stability and strong investment returns, they might ease off the brakes and look for growth opportunities. At the end of the day, surplus and capital reserves are what keep insurers solvent and stable even when the unexpected happens. For regulators, it's about protecting consumers. For insurers, it's about balancing risk, reward, and long-term strategy. If you're curious about the financial engine behind the insurance industry, or thinking about a career in insurance finance, actuarial science, or risk management, this is a fascinating area with real-world impact. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and follow InsurKnowledge for more insights into the world of P&C insurance.